Hey, I'd like to welcome you to another episode of the Mission Matters Business Podcast, your source for all things business. My name is Adam Torres. You can follow me on Instagram at AskAdamTorres to keep up with my book releases, book tour schedule, signings, all that other good stuff. Always love to connect with you there. And as always, if you'd like to apply to become a co-author of one of my upcoming books, just head on over to the website, missionmatters.com, and click on Become an Author to apply. All right, so today I have Steven Taracevicz on the line, and he's Managing Principal over at Aurora Capital Strategies. Steven, welcome to the show.
Thank you, Adam.
So excited to get into today's topic, how to retain value created in growing your business. You're the guy I'd want to talk to about that. But before we get into it, I do want to talk a little bit more about what you're doing over at Aurora Capital Strategies. So first, tell us a little bit more about the company, please.
Sure, Adam. So what we try to do is look at two different cases. Look at the case that you keep your company and how do you retain more value in the company. And we think of how much money you retain after taxes. And then if you sell the company, how much money do you retain after taxes, and to look at your return on an after-tax basis.
No, definitely. It's not how much you made on the sale, it's how much you kept in your pocket, right?
Exactly, sir. Absolutely.
Love it. Let's go a little bit further. So, how to retain value created in growing your business. So let's get deeper. So, where do you want to begin on that one?
Sure. And so, it's first of all understanding financial instruments. And the financial instrument that we use is a life insurance product. And the life insurance products have the aspect of being able to be funded using debt, number one. And that debt can be carried on a company balance sheet. And then that asset can be structured for the owners. It can be structured for the entire company. It can be structured for senior management. And then the question is if the company sells, how is that asset, further used to create value? And then there's the question is does the company stay in business, and how does that asset structured financially so that it continues to create value in the future?
So, I've been out of finance now for, I think, going on 4 years. I've been full-time in media, but I know when I was in finance, I was almost 14 years an advisor, and I'd sometimes get these referrals, and it would break my heart, Steven, because I get this referral, this amazing client, this amazing thing, and they're like, all right, Adam, I just sold my business. Now what do I do? And I'm like, you're supposed to come to me before you sell the business. What are you doing? It hurts when somebody does that. Yeah. Let's talk about because there's some people listening right now that didn't know what I just said. And some of them may be going through that process like as we speak, and they're like, wait a minute, I thought I was just going to take this check to my advisor or whomever I'm working with, and then they were going to make it all good. It doesn't work that way. Let's get a little bit more into kind of how the planning process works. I think that'd be valuable for the audience.
Absolutely, Adam. And so what we look at first is what the value of the business is. And that what we try to do is to assume as much of that value of the business is and put it inside of a vehicle that's held outside of the company. And the vehicle could be a trust, it could be an LLC. And I'm talking a little bit more on what I call the mechanics side of the business. Mm-hmm. And when you think of it as a pension fund-like asset. And so a pension fund-like asset would have two characteristics. Number one, it would be kind of like dotted line to the balance sheet. So for balance sheet purposes, it's held on the company, right? And then for asset protection purposes, it's held outside of the company, such that creditors can't seize it. And so that's just a little bit on the mechanic side. And then on the second side, we look at how do you fund this economically that's efficient. And so the cash flows of any company usually are best suited for growing a business. And so that when you look at creating savings, and when you look at in paying out in bonuses, sometimes that money is better suited to have inside of the business. So our preferred funding mechanism is debt, to fund the asset with debt, because it's very easy to get a collateralized, non-recourse loan to fund that asset. And then what we look at is like, how does it get unwound? And then what it does is it takes advantage of a theory that won a Nobel Prize called Miller and Modigliani. And Miller and Modigliani said years ago that regardless, in the absence of taxes, of how a company is financed, whether it's financed 50% with equity and 50% with debt, it has the same value. So that's the number one thing. And so what we essentially do in very simple terms is take a percentage of the total value of the company, and let's assume it's equity funded, and through debt and then later paying off the debt through the sale of the business or a refinance of the business, convert that equity into a life insurance product that's held outside of the company. And then as doing so, you have tax-deferred accumulation, and then through a policy loan, you have cash withdrawal out of the asset without a tax consequence. And then in the process, your tax basis then for capital gains, if you sell the business, is reduced, right? Because if your business is worth $100 million, and that, you know, instead of having and paying capital gains on $100 million in equity, you're paying capital gains on $50 million in equity, you've reduced your capital gains by 50%. In the case that you don't sell the business, if you look at the same after-cash dollars to fund the same asset or to pay out the same benefit over a given time period, it's much, much more economic to borrow the money at a rate of maybe about 4% of an asset that's growing at, 5, 6, or 7% based on how the asset is structured. That you're much further ahead if you refinance that with a business loan as opposed to a non-recourse premium finance life insurance loan, and you refinance that at a 10 and or 20-year refinance point, and at that point you take the equity, and like most people do when they leverage up a business, the reason for leveraging up a business is to increase their returns to equity. But then the problem is when they're taking that money out, they're taking it out and they're being taxed at a, depending on how they're taking the money out, they're getting taxed at ordinary income, or they could be getting taxed at capital gains. But when it's done through an insurance policy that's the main asset that's held outside of the company, you can avoid this.
And so so when you think about this strategy, so premium financing, when you think about taking on debt, I mean, just so that the people are listening have a feel for what type of niche and or size of company this is appropriate for, because this strategy is definitely for your higher income earners and for your, good sized businesses. What are the good niche and good areas for somebody that's listening to this to think that, okay, this is something they could potentially explore?
Yeah, I mean, that's a great question. I mean, we look at businesses with revenues of $5 million on up. And the reason being is that notionally you want to do a deal where your annual premium that you're financing is about $1 million. And so a business of that size, let's say $5 million of revenue, usually can afford an annual interest payment of about $25,000. In just, very simple terms, so $25,000 to $30,000, and we calculated backwards because their equity interest in the structure is part the interest they pay and part the collateral that they pay, and so when you add that all up, that usually is for most businesses and what most businesses are making in terms of profits and what they can afford in terms of expenses. It's going to be something in the vicinity of about $5 million in revenue.
Fantastic. That's spot on. And so, Steven, if somebody is listening to this and they want more information on Aurora Capital Strategies or to connect, what's the best way for them to reach out?
Sure. Thanks, Adam. They can reach out to me either on LinkedIn or on our website, which is www.aurora, AURORA capital.us, as in the United States.
Fantastic. Well, hey, Steven, been awesome having you on the show today, and you telling us more about what you're doing to help business owners out there to retain value. And to the audience, as always, thank you for tuning in. Hope you got a lot of value out of this. If you did, don't forget to subscribe to the podcast, leave me a review on the Apple iTunes Store. If you're watching this on our YouTube channel, Mission Matters Business, don't forget to subscribe to the channel and leave us some comments in the comment section. Love to continue the conversation over in the YouTube community. And Steven, thanks again for coming on the show.